Let's play a game of imagination. Fast forward to Tuesday morning, January 2026. You are 65 years old. The sun is coming up. You pour yourself a fresh cup of coffee and open your laptop, not to work, but to check your freedom fund. You see a number. It's a big number. And more importantly, it's a number that grew overnight while you were sleeping. This isn't a lottery win. This is the mathematical certainty of a properly engineered ETF portfolio. But here is the brutal truth that keeps me up at night. Most people watching this will never reach that morning. Statistics show that the median retirement savings for Americans aged 55 to 64 is roughly $185,000. That is not enough. Inflation is an invisible shark. If you leave your money in a savings account, you are safely losing money. You are guaranteeing your own poverty. You need an engine. You need a system. Today on the Capital Note, we are going to build that system together. I am going to break down the absolute best ETFs for a 2026 retirement. We will cover growth, income, and stability. I'm not just going to give you tickers. I'm going to show you the why and the how. By the end of this video, you will have a blueprint. Before we buy anything, we need to understand the strategy. I call it the tripod theory. A camera tripod needs 3 legs to stand on uneven ground. Your portfolio is the same. If you only have growth, a crash destroys you. You need 3 specific legs. Leg number 1, the market mover. This is the core engine. This is where we bet on the resilience of the American economy. There are thousands of stocks out there, but you don't need to find the needle in the haystack. You just need to buy the haystack. Enter VOO, the Vanguard S&P 500 ETF. This is the gold standard. It tracks the 500 largest publicly traded companies in the US. When you buy 1 share of VOO, you essentially own a tiny piece of Apple, Microsoft, Amazon, Google, and Berkshire Hathaway. Why VOO? Because the S&P 500 is self-cleansing. This is crucial to understand. If a company in the index starts to fail, it gets kicked out. If a new company becomes dominant, it gets added. It is survival of the fittest, applied to your money. Let's talk cost. VOO has an expense ratio of 0.03%. This is practically free. Wall Street hates this product because they can't make fat commissions off it. If you invested $10,000, Vanguard charges you $3 a year. A cup of coffee costs more. Now I hear some of you asking, what about VTI? VTI is the Vanguard Total Stock Market, ETF. While VOO holds 500 companies, VTI holds over 3,700. It includes small caps and mid caps. It's the entire US market, not just the giants. Honestly, it's a coin flip. Their historical returns are 99% identical. If VOO is up 10%, VTI is usually up 10%. I prefer VOO for retirement because large cap companies tend to be slightly more stable. The key is to pick one and stick to it. Leg number 2, the cash cow. This is where many retirees fail. They have growth, but they don't have cash flow. You don't want to sell your stocks when the market is down just to pay for groceries. You want your stocks to pay you. For this, the heavyweight champion is SCHD, the Schwab US Dividend Equity ETF. SCHD is not just a dividend fund, it is a quality fund. It tracks the Dow Jones US Dividend 100 Index. SCHD has a strict screening process. It only buys companies that have paid dividends for at least 10 consecutive years. It looks for cash flow to debt ratios. It avoids yield traps. The result? A dividend yield around 3.5%, which is double the S&P 500. But the magic is the dividend growth rate. SCHD companies historically raise their dividends by 10 to 12% per year. Let me explain why that matters. Imagine your pension payout increased by 11% every single year. That destroys inflation. With SCHD, you are building a paycheck that gives itself a raise. This is the ultimate hedge against the rising cost of living in 2026 and beyond. Comparing SCHD to other income ETFs like JEPI or QYLD, those use options strategies, covered calls. They pay higher yields, maybe 10 to 12%, but they have zero capital appreciation. The stock price often decays. SCHD gives you both. Leg number 3, the turbo boost. Now, traditional advisors might say, you're retiring, don't take risks. I disagree. You might live to be 95. You need exposure to the technology that runs the world. This is where QQQM comes in. This is the Invesco Nasdaq 100 ETF. It is the younger, cheaper brother of the famous QQQ. It holds the same stocks: Apple, Microsoft, Nvidia, Meta, Tesla, but with a lower fee. The Nasdaq 100 is pure innovation. These companies have massive cash piles and monopolies on the digital economy. Over the last 10 years, the Nasdaq has absolutely crushed the S&P 500 in total return. However, QQQM is volatile. It's a roller coaster. In 2022, it dropped over 30%. That is why it is the smallest leg of our tripod. It is the spice, not the main course. But that spice is what can turn a comfortable retirement into a luxurious one. Finally, we need a safety net. What if 2026 is a bad year? What if the market crashes right when you hand in your resignation letter? You need an asset that zigs when the market zags. BND, the Vanguard Total Bond Market ETF, or SGOV, for short-term treasury bills. For a long time, bonds were trash because interest rates were zero. But now, we are in a new era. With rates higher, BND provides a yield of around 4 to 5%. It acts as a shock absorber. When stocks panic and sell off, investors flee to the safety of bonds, which stabilizes your portfolio value. It prevents you from panic selling at the bottom. So we have the players: VOO, SCHD, QQQM, and BND. Now, how do we field the team? This is the secret sauce. I propose the 50-30-10-10 split for the modern aggressive retiree. 50% in VOO, or VTI. This is half your money. It's the bedrock. It ensures you never underperform the broader economy. 30% in SCHD. This creates your income floor. A $500,000 portfolio would have $150,000 here, generating about $5,000 to $6,000 a year in dividends right off the bat, growing every year. 10% in QQQM. This is your 10% play money that isn't playing. It's working hard. If tech booms, this 10% could grow to become 20% of your portfolio. 10% in BND, or cash. This is your sleep well at night money. If the market crashes 50%, you don't sell your stocks. You live off this 10% for a year or two until the market recovers. How do you actually do this? You don't need a financial advisor taking 1% of your money. That 1% fee destroys 25% of your wealth over 30 years. You can do this yourself. Open your brokerage app, search for the ticker, select buy, choose market order, enter the quantity. Hit confirm. Congratulations, you are now an owner of the world's best companies. It takes less than 30 seconds. But wait, there is one more critical step: rebalancing. Once a year, say on your birthday, check the percentages. If QQQM has gone up and is now 15% of your portfolio, sell the extra 5% and buy more BND or VOO. This forces you to do the hardest thing in investing: buy low and sell high. Rebalancing automates discipline. It takes the emotion out of the equation. You are not guessing. You are just following the math. The strategy is simple. The execution is hard. Why? Because we are human. We have fear. We have greed. When the headlines say market crash imminent, your brain will scream at you to sell everything and go to cash. In 2020, the market dropped 30% in a month. People panicked. They sold. And they missed one of the greatest rallies in history. If you had simply done nothing, you would be up huge today. Time in the market beats timing the market. It is a cliche, because it is true. If you miss the 10 best days of the stock market each decade, your returns get cut in half. You have to be in it to win it. Let's address the taxes. If this is in a Roth IRA, all this growth and all these dividends are tax-free. Forever. If this is in a standard brokerage account, you will pay taxes. VOO and QQQM are great. They are very tax efficient. What if you have $100 to start? Or $1,000? It doesn't matter. The percentages work the same. You can buy fractional shares. You can start with $50 a week. The important thing is to start today. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Don't be the person paying it. Be the person earning it. Let's recap the 2026 retirement blueprint. Core, VOO for reliable growth. Income, SCHD for cash flow and dividend growth. Growth, QQQM for the future tech boom. Safety, BND for the stormy days. This isn't just about money. It's about autonomy. It's about the ability to say no to a boss you hate. It's about spending time with your grandkids without worrying about the electric bill. That is what we are really buying. I want you to take action. Don't just watch this video and move on to a cat video. Open your account, look at these tickers, read the prospectuses. Take control of your financial destiny. If you have questions about which brokerage is best or how to set up automatic investing, drop a comment below. I read every single one. We are building a community of wealth builders here. Thank you for investing your most valuable asset with me today, your time. If this video helped you, please hit that like button to help the algorithm find more people like us. Subscribe to the Capital Note, and I'll see you in the next video. Let's get rich.